All right, hello, welcome to chapter 4. Again, I'll do some walkthroughs of some exercises that apply to the partnership chapter, and hopefully you've had a chance to complete some AME work, perhaps finish off chapter 3, of course, and get started on chapter 4. I've had a few questions from some students about chapter 4, so that's good news. So hopefully it finds many of you keeping up or doing some of that work. So just a reminder, I posted an announcement today about the pending test 1 or midterm coming up. It is to be taken on Friday, October 29th, sometime that day between 10 and 10. 2 hours long. It'll only be on chapters 1 to 5. And I would recommend, obviously, you want to start before 8 p.m. to have your 2 full hours. So please find a time in that 12-hour window to complete your test on the AME platform. You will see it on AME. If you scroll into there just below chapter 5, you'll see a practice test that you can take just to test some of your knowledge in preparation. And then there's the real test as well. Again, that will be open at that time. So we are going to flip over to chapter 4, and I'm going to do a verbal walkthrough like I've done the last few weeks of some examples just to help with some of the lessons and learning that hopefully you've either listened to tutorials about or the recorded lecture from a few days ago. So I'm in the workbook, chapter 4. It's page 141 of the workbook or page 5 of the PDF for this chapter. And I'm looking at question 1 just to have some conversation. So if you recall, we talked a little bit about some of the types of partnerships. And we're asked to list some of the characteristics of that specific partnership and whether it's an advantage or disadvantage. So the first characteristic is there is an unlimited liability of all partners sometimes. Okay, is this an advantage or disadvantage? Well, in this situation, it's a disadvantage in the fact that there's no protection of loss. If one partner makes a poor decision and has no more assets to pay, you as one of the other partners might be subject to compensate for that shortfall. So that completely unlimited liability general partnership means all the partners share in it. But if one partner doesn't have any more assets, you're on the hook. The ability to raise capital, obviously, we're calling this an advantage because the general partnership increases the ability to grow your business. So typically it has more access to cash and other resources. And what they mean by that is if you were a sole proprietorship, one person, it's one person's assets and resources. But if you have 2, 3, or more, whatever number of partners, the idea is they have more connections, more ability, likely more credit that they could bring into this general partnership. So they could use those or leverage those to help grow that said partnership. When we look at combination of resources, we say that's an advantage as well, because not just assets that they could bring to the partnership, but areas of expertise. And if you look at Shark's Tank or Dragon's Den, any of those, and there are different people that are those rich investors looking for potential opportunities. They also bring more than just money. They bring connections. They bring special expertise, perhaps, somebody that might be better technically or better as a salesperson or a marketing person or a social media person, whatever that might be. So by combining your resources outside of just cash or other assets, it can be seen as a great advantage to the organization. How easy is it to formate? It's definitely an advantage for partnership. It's relatively easy. Corporation, is a whole legal craziness that you have to go through. But a partnership is relatively easy. You can do it on a verbal agreement. Strongly recommended not to. You should get it documented and signed off by each of the partners. But it can be drafted up in theory on a napkin over a drink if so desired, as long as you're not drunk, because that could get you in some hot water. And the last characteristic of mutual agency, we say that's a disadvantage because it may be good that one partner can represent the business if somebody's missing, but that mutual agency might also be a disadvantage because one partner has the right to enter into a business transaction without the other one's knowing or getting the approval. So you want to be careful, perhaps even writing in your partnership agreement that no single partner has the right to enter into a new service contract, whatever that might be. So it's something to consider when you're starting a partnership. Okay, we talked about the limited liability component before in the lecture, where it's typically found in accounting firms or legal firms, where the losses incurred or liability incurred by one partner because of decisions or recommendations they made are not shared with the other partners. So that's considered a limited liability partnership. So there's an example in question 2 that talks about that. So I'm going to skip down to question 4 now. So on question 4, it talks about on May 1st of 2020, we have these 3 folks, Natalia, Sam, and Cici. They form a general partnership and they open a small convenience store. Everybody puts 10 grand in cash, and Natalia also invested equipment worth $5,000. So it asks us to calculate the total contribution of each partner. And on the screen, you'll see we've set up 3 columns for the 3 partners. Okay, and we have the cash contribution of each, the equipment under Natalia. So the total partner contributions each are Natalia at $15,000 and Sam and Cici at $10,000 each. So in this relatively simple partnership to begin with, our journal entries to set that up would be to debit the cash account for the total amount of cash coming in and credit the 3 capital accounts for their contribution to that cash. But the second component would be a debit to equipment for the equipment that Natalia brought in. So that would be a debit to the equipment in the capital and a credit to the capital account for Natalia. You could merge these into one entry, assuming it's happening on the same day. We've spelled it out separately just to make it a little easier to follow. So I'm going to flip screens for a second. So we're going down to step 5. So I built this little schedule to help support it, because if you were to follow this one and just jump to the answer and try to figure out, sometimes it isn't quite clear. So if I flip over to my other file here, okay, so we've got question 5A. It says we have 4 people that started a general partnership and brought the following assets and liabilities into the new business. We have Lee, Fire, Linkman, and Redgrave. Okay, they're bringing in cash, AR, some notes payable, liabilities, etc. One partner is bringing in a fairly expensive building, and others. And then there's a note, though, that says the independent appraiser determined that the allowance for doubtful accounts should be 600. And if you look, there's one that's at 800, so it's overstated. And the equipment's fair market value is 10,000. So we look at equipment, it's 11. Take away the accumulated depreciation as the contra account. So its net book value to Fire is 10. So that's equal to the fair market value. All other assets and liabilities have a fair value equal to their book value. Okay, so if you look at the building, for example, we're assuming it's worth 240. So you've set up this little schedule just to help you walk through this. And we've got the 4 partners. We've got for Lee, we've got cash, accounts receivable. Originally, it's $800 in allowance for doubtful accounts, but we're told it's actually 600. So we'll change that to 600. And then the notes payable is a liability, so we have to subtract that from what Lee's bringing in. So the total capital up front from Lee is $15,900. Under Fire, actually, and just to double check, we've got $15,900 over here. Good. Under Bob Fire, he's bringing in cash, equipment worth 10,000. So then we close and we don't bring in accumulated depreciation because the asset is based on the value that's being transferred in. So we go 10,000 in, and then we'd have a notes payable of a minus 8,000 or credit balance. So we have 57,000 in capital for Fire. Linkman 28 plus 240 is 268,000, and Redgrave just cash at 60,000. So again, if we look at what we have on this list, we've got 59, 57, 268, and 60. So that helps support this journal. So back to my Excel document then, is I've categorized these in a journal format. So therefore, anything that should be debited, for example, the assets that the partners are bringing in, will be cash at a total of 157,000. We have accounts receivable at 5,000. We have equipment worth $10,000. We have the building at $240. And then our credit balances are our allowance for doubtful accounts at $600, the value that it's determined at. The notes payable totaling $10,500 from Lee and Fire. And then we've got the 4 capital amounts. So those come in from the subtotals on the screen here: $15,900 for Lee, $57,000 for Fire, $268,000 for Linkman, and $60,000 for Redgrave. And that's our opening journal. So then if we go back, B, I didn't spell out separately because it says that earnings are equally divided. So you know what? If they earn $360,000 in a year and there are 4 partners, it's $90,000 each. You split it 4 ways. So in that situation B, hopefully we can all do divided by 4, whether you use a calculator or not, doesn't matter. And it assumes that the income summary account is ready to be debited. So the income is sitting in income summary. So we would debit the income summary account to pull it out, and then credit the 4 capital accounts, 1 for each partner, for their 1/4 share of the $360,000. So that's one scenario. Okay, so assume that scenario is out the window. We want to go through a different scenario. So independent of part B, suppose that it was decided that Bianca Lee will get 10%, Bob Fire will get 25%, Larry Lankman will receive 40%, and Frida Redgrave will get 25% of the profits. And assume they had a net loss of $15,000. So if I go back to my file here. So if we take the percentages as noted here, actually I did take a snippet of that, so hopefully you can see this on your screen. We take the 10%, 25, 40, and 25, which adds to 100. So it's my double check to make sure the allocation is 100. We have a loss that we need to record. So we'll be debiting or reducing the capital balances: $1,500 for Lee, $3,750 for Fire, $6,000 for Linkman, and $3,750 for Redgrave, total of which is $15,000 credit. So I have this is the total to be allocated. This is the total of my allocations to make sure that they are one and the same. Our journal entry to record that would be a debit to each of those 4 accounts for the set amounts, and a credit to the income summary for $15,000 because there's a net loss in the balance of the income summary. Moving on to step D, so independent of parts B and C, so forget that for a moment. Let's suppose that it was decided that the earnings will be divided based on each partner's capital contribution. Okay, so we have our capital contributions over on the left-hand side. And let's assume that during 2020, the company earned a net income of $86,000. So we know our income summary will be debited for $86,000 because if it had a net income, our income summary has a credit balance. So I've set up a little table at the bottom here that pulls in the capital from Lee, Fire, Linkman, and Redgrave, which totals total capital of $400,900. And then based on that allocation, I've just rounded to the closest dollar, take the $15,900 divided by the total of all partners times the $86,000 to be allocated. Lee should be attributed $3,411. Similarly, Fire, 57 divided by 400.9 times 86 gives $12,227. You would complete that same allocation for Linkman and Redgrave. So you would have a credit to their 4 capital accounts in the amount of $3,411, $12,227, $57,491, and $12,871. The total of all of these is which $86,000. And I think that's it for question 5. I just want to double check. Yes. All right, I want to skip to number 7, which again, I've set up a little spreadsheet here. So number 7 says Brian, Miley, and Adriana operate a business as a general partnership, so not a limited liability. It was decided that the 3 of them will receive salaries of $65,000, $70,000, and $55,000 respectively. The remaining profit or loss will be equally divided among the partners, and during the year, the company earned a net income of $160,000. and we're to calculate the share of net income that will be allocated to each partner. So first of all, we know we have net income of 160. First step is to take salaries. So Brian gets 65, Miley gets 70, Adriana gets 55. That totals 190,000, which is greater than the original salary. That leaves a balance of $30,000 loss to be allocated, and it says it's shared equally. So if we move this forward, we take a third of 30,000. It's a $10,000 reduction in each partner's allocation. So therefore, the total amount allocated from the net income or the income summary account of 160,000 gives 55,000 to Brian, 60,000 to Miley, and 45,000 to Adriana. Okay, so you need to break it down in steps. Salaries first, as per the instructions, and then everything is a third. There was a loss, so everybody's share was reduced. We're going to look at number 8. Number 8 says Anna, Peter, and Jackson formed a limited liability partnership in 2019. In 2020, the beginning capital balance of each partner was 25,000, 35, and 30,000 respectively. During 2020, the company earned a net income of 63. Anna withdrew 25,000, and Peter and Jackson withdrew 40 and 35 respectively. So step A says, let's calculate the amount of net income each partner will receive based on the following independent scenarios. So the first scenario, earnings are divided equally. So we have 3 partners, $63,000. We would then just divide by 3 to get $21,000 each. Second scenario, Anna receives 30%, Peter 40%, and Jackson 30%. So we split the 100%. Take the 30% times the 63,000 of income, you'll get 18,900. 40% times 63, 25,200. And Jackson 30%, same as Anna. So we'll have 18,900 for Jackson as well. Third option says the earnings are divided based on the partner's capital balance at the beginning. So we were told that the beginning balance at the year was 25, 35, and 30. So we'll take the 25,000 divided by the total, which is what, 90,000? I should have added this up before. Yeah, 60, 90,000. So you would take 25 divided by 90,000 times 63. It happens that Jackson has a third, 30 out of 90, so his number is the same as scenario number 1. And then there's a little bit of shift between Anna and Peter taking that pro rata component. Okay, so those are a few different scenarios, just so you can apply some of the learning. So now let's assume method 2 is used, which is based on the 30, 40, 30 split. And let's calculate the ending capital balance for each partner. We were told that their opening was 25, 35, and 30 respectively. And then we would allocate the net income. Our option 2 said 18.9 to Anna, 25.2 to Peter, 18.9 to Jackson. So our subtotal, if we add our share of net income, would be 43.9 Anna, 60.2 for Peter, and 48.9 for Jackson in thousands. But then they each took money out. So if we go back to our paragraph, Anna took out 25, Peter 40, and Jackson 35. So we need to subtract their withdrawals, 25, 40, and 35. So we'll have ending capital balance for Anna of 18,900, Peter would be 20,200, and Jackson would be 13,900. You'll notice that they all took out more than they earned in years. So they're actually decreasing the equity in the organization. Not necessarily a bad thing, but just something to make a note of. Scenario C. So let's assume that they decide to receive a salary between Anna, Peter, and Jackson of 40, 55, and 45,000 respectively. The remaining earnings will be divided among each partner equally. So their salary, then equal share. Let's assume in this example that the company earned a net income of $149,000. And we're asked to calculate the amount of net income that each partner will receive. So we start with our net income of $149,000. We enter the salaries of $40,000, $55,000, and $45,000 respectively. Means they take a total salary of $140,000 there, leaving a profit remaining of $9,000. We would therefore split that 3 ways. Anna, Peter, and Jackson, $3,000 each. So the total allocation would be Anna for $43,000, Peter for $58,000, and Jackson for $48,000, totaling the $149,000 of total income for the partnership. Okay, let's assume point B. Let's assume they withdrew 10, 15, and 12,000 respectively, and we didn't do the journal yet. So we're asked to do the journal entry. So here we have withdrawals for Anna, Peter, and Jackson. We need to debit because we need to increase the amount of withdrawals, 10, 15, and 12,000 respectively. And we're assuming they took out in cash. It doesn't tell us otherwise. So we will credit cash for the total being $37,000. In real life, I would do them as 3 separate entries. So you can see Anna's money coming out of 10, Peter's of 15. You probably cut them a check or an EFT. So I would split this entry 3 ways, but that's okay for applying the lessons. Okay, so now it says using the values from part C and D, let's calculate the ending capital balance for each partner. Let's scroll for 2021. Okay, so we have the ending capital balance in point B of 18.9, 20.2, and 13.9. Okay, so it says assume B is correct. So that'll be our opening balances here for 2021. Then we have the share of net income. If you scroll up to point C, we have 43, 58, and 58. Sorry, 48, 43, 58, and 48. Subtotals, 61.9, 78.2, and 61.9. And then their withdrawals as per point D of 10, 15, and 12. So we'll have ending capital balance for Anna, 51,900, Peter, 63,200, and Jackson, 49,900. Again, they grew their equity in the year drastically. All right, I'm going to skip down to number 10. All right, so we've got 10A here. So 10, I've split my screen. So the left side is the question, the table of data, and the right-hand side is what I'll walk through as we go so we can see the data together. So on the left-hand side, we have the following account balances were taken from the books of a partnership, A&A, on December 31st, 2020. Assume all accounts have normal balances. So think of accounting 1100, what has a debit, what has a credit normally balanced, and that the bank loan is being paid back through annual installments of $52,000. Principal plus interest on the outstanding balance. Also, assume that Alan contributed an additional $20,000 during the year and that this amount was added to his capital account. So we're given a list of the details. First step is we're asked to create the income statement. So just like every other financial statement, your top 3 lines, the name, the title of the statement you're preparing, and the period it's for. So in this case, the partnership income statement for the year ended December 31st, 2020. We look for our revenue, and we've identified service revenue of $545,000. And then we look for our expenses. So starting at the top of the list, we have advertising expenses of $100,000, insurance expense of $40,000, maintenance $5,900, rent $78,000, salaries $228,500, telephone $3,200, and travel $19,400. So looking at our income statement, we'll have total expenses of $475,000, subtracted from the service revenue of $545,000 to be a $70,000 net income. What I find helpful is if you have the workbook, you would just make a note here, maybe an extra column that says, category, assets, liabilities, equity, revenue, expenses, just to help guide you which statement they should show up on. Okay. The next statement then is the statement of partners' equity. We need that in order to feed the balance sheet. So just like in a proprietorship or a corporation, you would have a statement of owner's equity or a statement of shareholders' equity. This, we have a statement of partner's equity with columns for each partner. So here, if you look at the list on the left-hand side of the screen, it looks like we have two partners, P. Allen and S. Amir. So we've set up P. Allen and S. Amir. This is the statement of partner's equity for the year ended December 31st, 2020. So here we have the partner's capital as of January 1st, 2020, so 12 months prior. We're told that P. Allen's capital account includes an additional $20,000 in the year. So we need to back out that $20,000 to get what his opening balance would be. So for P. Allen, we have opening of $30,800 and the net investment of $20,000 to add up to what's in the current GL balance. S. Amir, we're not told that he made any, or he or she made any additional contributions. So we'll assume it's all opening at $57,400. Total opening equity would be $88,200. Total investments in the company would be $20,000. Net income, we're assuming this is a general partnership and it's split 50-50. So 35,000, actually it's right at the top of the screen, 50-50. So we had total income of 70,000 per our income statement. So we'll put 35,000 under Allen, 35,000 under Amir for a total allocation of the $70,000. Our subtotals then would be 85,800 for Allen and 92,400 for Amir. Next line would be to subtract your withdrawals. Looking at our list of accounts on the left-hand side, Allen had withdrawals of 25 and Amir had withdrawals of 15,000. Subtracting those amounts, we have closing partners capital and under Allen for 60,800 and Amir for $77,400. Total partners capital of 138,200. Next, we're asked to create the classified balance sheet. So classified meaning that we identify current versus long-term. So we've got the partnership. It's a balance sheet as at the end of the year being December 31st, 2020. Looking down our list on the left-hand side, we're going to put them in order of liquidity, current versus long-term. So under current assets, we have cash, 90,200, accounts receivable, 47,008, inventory of 32,000, total current assets of $170,000. Under our long-term assets, we only have equipment. You can see on the left-hand side here for 415, plus accumulated depreciation. That's our only asset account, so it must be accumulated depreciation on the equipment of 145. So we have total assets of $440,000. For liabilities, we have accounts payable, 26,000, unearned revenue, 15,800, again in the order that they're typically paid off. Bank loan, the current portion, we're told $52,000 each year. So our current portion of the bank loan is 52, which means if we skip a couple lines for a moment, our bank loan long-term portion, we take our total bank loan, left-hand side here, 260,000, less what's due in the next year, being the 52,000, will give us our long-term portion of $208,000. Back up to current liabilities, then we add up our AP, unearned revenue, and our current portion of the bank loan for total current liabilities of $93,800. The bank loans are only long-term liability, so we have total liabilities of $301,800. We then pull in the partner's capital from our statement of partner's equity that we just completed. So we have P. Allen and S. Amir capital of $60,800, $77,400 for total liabilities and partner's capital of $440,000. Our counting equation is balanced. That's success. Okay, we're going to move on to number 13 then next. So we have these three, I'm guessing ladies, but three people, Sylvia, Sonia, and Santa, are all partners who operate a beauty salon called S3 Beauty. And I assume ladies because of the names, not because of the beauty salon. So we're assuming it's S3 Beauty or S Cubed Beauty. On January 1st, 2020, the three of them had a capital balance of $320, $215, and $360 respectively. So we've set up our little schedule. to say that the capital balance was currently those three amounts, totaling $895,000. Quite the salon. A says, due to the successful growth of the business, the original partners have agreed to add an additional partner, Sharon. She will be investing $300,000 cash into the business. Calculate the new capital balance for each partner after Sharon has been added. So we're just assuming a straight add. She added 300,000. Total equity now would now be 1.195,000. No changes to the other three partners. If it was as simple as that, our journal entry would simply be a debit to cash and a credit to Sharon Capital for 300,000. Now, separately, what if they've made a good reputation for themselves in the market and has a large base of loyal customers? Since the company has a higher market value, Sharon has agreed to invest $390,000 and receive a $300,000 share of the business's book value. Any difference is split equally among the original partners. So in this case, she's investing $390,000, so our total has to change by $390,000. Sharon's only getting a $300,000 portion, so we plug that amount in. And then the other $90,000 of additional equity is allocated a third to each of the original partners, $30,000 each. So therefore, our our new capital balances after admitting the new partners would increase for the three originals to $350,000, $245,000, and $390,000 for Sylvia, Sonia, and Santa, respectively. Sharon's equity would only be $300,000, so she's paying $390,000, but she's only getting a $300,000 share. Now, to prepare this journal entry, total cash coming in is a debit of $390,000 because the value is increasing that much. Now, the capital accounts, so we will hit all four partner capital accounts. We will credit the three original partners by $30,000 apiece, and Sharon, being a new partner, for only $300,000 of the contribution. Separate scenario again, question E. Sharon herself has made a good reputation for herself in the market and has a large base of loyal customers, so flipping it the other way. Since a partnership with Sharon will be very beneficial to S3, he'll provide Sharon with a $300,000 share for only $285,000 investment. And the difference is split equally. So opposite to question C. So here, total investments $285,000, but Sharon gets $300,000. So for we have a negative or a discount that's offered. So we have a discount of $15,000 split equally to the original three partners would be a reduction in their capital account of $5,000 apiece. Capital balances for Sylvia, Sonia, and Santa then would decrease to $315,000, $210,000, and $355,000 respectively. Total equity would be $1.18 million. The journal entry to record this scenario would be an increase to cash debit, $285,000. That's how much money Sharon is putting in. A debit to the three original partners' capital accounts for $5,000 each for the discount. And Sharon's getting credited to her capital account $300,000 in value. So with a little bit of analysis, what happens to an existing partnership when a new partner is added? So the old partnership stops. Okay, a new partnership begins from the date that that partner is added. A new partnership agreement must be prepared and signed by all parties. Okay, because you actually need to admit a new partner. You need to talk about allocation of income and all of that good stuff. However, the business doesn't always have to start a new set of books. So sometimes you want all that old history. So you would just roll forward and do the journal entries accordingly. Maybe you even rename. That's okay. You can still keep that history in there. And those adjustments can be made. Okay. All right, question 15. Because we have this scenario where 20 years ago, three brothers formed a general partnership, and they now want to end it because new government regulations make the business less profitable. Before the liquidation, the partnership had cash valued at $10,000, non-cash assets recorded at $500,000, and liabilities at $300,000. The partners' capital account balances were $60,000, $70,000, and $80,000 for brother A, B, and C, respectively. The brothers sold the non-cash assets for $530,000 and paid off the liabilities. Note that any profits or losses are distributed equally to the partners according to the terms of the partnership agreement. So we need to create the journals. So first of all, our cash gets debited for $230. Our liabilities, we need to pay those off of $300,000. And our assets need to be sold off, so credited for $500,000. So the net of it all would be a credit to the gain on sale of assets for $30,000 because they sold their non-cash assets for $30,000 more than what they were on the books. Therefore, the next journal entry says, okay, now we need to allocate that gain to the capital accounts of each brother. Gain on sale of assets would be debited to close that out. And each of the three capital accounts would be credited a third $10,000 apiece. Now we would distribute the remaining cash, which should be the $230 plus the original 10. So there should be $240,000 of cash sitting in the bank account for this partnership. We would allocate that $240 based on their capital. The capital we were told was 60, 70, and 80. However, they all went up by 10. So now it's 70, 80, and 90,000 for brother A, B, and C respectively. So we would debit the three capital accounts, 70, 80, and 90,000, which totals the $240,000 in cash that they would then take out and put in their personal accounts. Hope you found some of this helpful, and have a wonderful day.